Namaskar friends, welcome to the channel JIV and CIV Made Simple. In this video, we are going to discuss our CTP Certified Training Professional Certification Course 11th July 2026 memory based question along with answer. If you have not seen my previous memory based question explanation session, you can check out the link in the description section. There is a complete playlist of all the memory based question of all the examination which are held from 2025. So let's get started with our very first question which was asked in the examination. So the question is, in the Indian secondary market, what is the standard rolling settlement cycle for outright transaction in the government security executed on negotiated dealing system order matching platform, and which entity assume the counterparty risk for these trade? Option they have given. Friends, let me answer this question. Imagine that you are buying an expensive second hand laptop from a totally a stranger on the internet. Okay, so what you are doing, you are buying second hand laptop from a total stranger. Okay, you are probably a little nervous, right? You think, what if I send the money and they never ship the laptop? The seller is just as nervous, thinking, what if I ship the laptop and their payment bounces? In finance, that fear is called, counterparty risk. In the finance, that fear is called the counterparty risk, right? The risk that the person on the other side of the deal flakes out. Now imagine a giant super trusty security guard. So you imagine a giant super trusted security guard. Okay, he steps between the two of you. The guard say, don't worry, both of you hand your item to me tomorrow. So this is person number one. This is person number two. Both of you hand to me, right? Hand your item to me. This is me, right? Tomorrow. So I personally guarantee the buyer get the laptop and the seller get the cash, right? So actually, both are frightened, right? Both are terrified. So one person the fearing the risk that what if I send the money and they never send the laptop? Other person thinking, what if the finance bounces, payment bounces, right? So that is the super trusted security guard. This is the guard, super trusted security guard. Okay. So in banking world, government security are just loan to the government, right? Government security act like a loan to the government. When bank trade these loan, they use a massive digital platform, and obviously bank trade these loan, right? So they use a massive digital platform to make sure that nobody flakes out. They use a security guard to guarantee the trade. Yeah. So in this particular case, a security guard is used to guarantee the trade, and the settlement cycle is simply the delivery time. So when I say T stands for the day you made the trade. The day you made the trade, that's called T. And if the delivery happened tomorrow, that's called T plus 1. If it is happening tomorrow. So what is the correct answer to this question? The correct answer to this question is option number B, T plus 1, right? And CCIL, right? So here is why, because when a government bond trade happened today, right, the actual exchange of the bond and the cash happened the very next working day. See, when I say T plus 1, we are only referring to the working day. I'm not referring to days, I'm referring to the working days. So T plus 1, which means the actual exchange of the bond, the actual exchange of the cash happened the next working day. The trusted security guard then step into the middle to guarantee everything is called CCIL, Clearing Corporation of India Limited. Right. Now what about option A? It is out because it said P plus 0, same day delivery. This is not a standard for this trade. C is also wrong. It said T plus 2. It is very slow. And SEBI is the stock market police, not the bond market middleman. Yeah, we're talking about the government security, just like a bond market. So to nail this on exam day, just visualize an Amazon Prime delivery box. You can visualize it like, an Amazon Prime delivery box with a big letter C written on it. This is the box and big letter C written on it. So think CCIL gives you confidence, right? CCIL gives you confidence with 1 day delivery, right? So CCIL means confidence, T plus 1 means 1 day delivery. Whenever you see a question about who takes the risk for government bond, look for the confidence of 1 day delivery. Now, have a look at the question number 2, right? So, question number 1 we have already done. Now, question number 2 is on your screen. So question 2 is regarding the banker's acceptance. Which of the following statement most accurately define a banker acceptance within the context of the international trade and short-term money market? Option they have given, it is immediate demand draft payable by the importer bank upon the presentation of the shipping document. It is a method of self-financing where the bank retain the legal title to the good until the buyer complete the final payment. It is a time draft drawn on and accepted by a bank representing unconditional obligation of that bank to pay a specified sum. It is a revolving credit agreement provided by central bank to ensure commercial bank maintain adequate daily liquidity. So let me give you a simple example to make this bankers acceptance crystal clear. So imagine you are selling a massive shipment of spices to a buyer in another country. This is you, and what you are doing, you are selling massive shipment of spices to where? To a buyer in another country. The buyer say, I will pay you in 90 days. Buyer say that I will pay you in 90 days. Fine. You don't know this buyer very well. What if their business goes under before day 90? You would be completely out of luck. Now imagine the buyer bring their rich, highly reputable uncle. Yeah, buyer bring their rich, highly reputable uncle into the deal. The uncle who happened to be the major global bank. Yeah, this uncle is what? It happened to be, global major bank, right? He enter into that particular bank, enter into the deal, right? He takes the 90-day IOU, stamp it, sign his name across it. So what uncle did, he take the 90 days IOU and then he stamp it and take the risk, right? By doing so, uncle is saying, I personally guarantee this money will be paid in 90 days, no matter what is happening to my nephew. Suddenly, you are not worrying about the buyer ability to pay. You are relying on the bank deep protect because you are relying on it, because he has signed, because he has stamped, right? You are relying on the on bank's deep pocket. So this signed iou is called basically banker's acceptance. The bank has literally accepted the responsibility to pay the bill at a future date, right? This signed iou is called banker acceptance, and bank has literally accepted the responsibility, right, to pay the bill at a future date. It takes the risk away from the exporter and puts it squarely on the bank's shoulder. So if you look at the option that they have provided, so it is an immediate demand draft, it is a method of self-financing, it is a time draft drawn on accepted by the bank, it is revolving credit. The correct answer is option number C, right? So here is exactly why other are wrong. Option number A talks about immediate demand draft. So bankers acceptance are always about the future payment, not immediate one. Option A is wrong. B describes something more like an auto loan or lease where the lender hold the title to your car until you pay it off. Yeah, this is not the correct answer. If you look at the option D, they describe central bank lending tool used to keep bank afloat with daily cash, which is completely unrelated to the international trade finance. So yes, whenever you see this banker acceptance on the exam, think of the letter B. I'm just giving you a trick to remember this. You can think of the letter BA and the word time. Remember, BA means what? BA means bank autograph. Bank autograph. So whenever the bank put it autograph on a time draft, right? On a time draft. Okay, they are locking in the future payment. Just picture a banker signing an IOU with a giant ticking clock next to them. If you see the word time draft unconditional obligation, you have found your right answer. And that is nothing but, banker's acceptance. Now, friends, let's look at the next question we have. Which of the following infrastructure of Indian financial system, right? Within the infrastructure of the Indian financial system, which of the following statement most describe the role and structure of the infinite? Option A. It is an open access payment gateway developed by NPCI specifically to process retail UPI and RuPay transaction. Option B. It is closed user group communication network operated by IDRBT that serve as a secure backbone for critical national payment system like RTGS. Option C. It is Reserve Bank of India internal CBS core banking solution used exclusively for managing sovereign government account. Option D. It is a cross-border financing messaging system established as an alternative to SWIFT for Asian nation. These are the four options they have provided. So now let me break it down in the layman terms. So think about the regular internet like a massive public highway. You can think of them like a massive public highway, right? Anyone can drive on it. Okay. So you can think of the regular internet as a massive public highway. Anyone can, drive on it. You, me, business, and unfortunately, even hackers and thieves. They can also drive on it. Now imagine You need to transport billions of dollars between bank every single day. This is bank one. This is bank two. And you have to transport what, billions of dollars. You have to transport billions of dollars between bank every single day. You would not want those digital armed truck driving on the public highway, right? There is too much risk. Instead, you would build a secret underground VIP tunnel. What you will do? You will build a secret underground VIP tunnel, right? Just for the bank. No regular card allowed. You would build a VIP tunnel for the bank. No regular card allowed. Because you have to transport if you think about you can think of regular internet like a public highway. Anyone can drive on it, right? But suppose you have to transport billions of dollars between bank every single day, so you will build a VIP tunnel. In the Indian banking system, this VIP tunnel is called the Infinite. Yeah, in the Indian banking system, this VIP tunnel is called the Infinite. It stands for the Indian Financial Network. What's the full form? Indian Financial Network, right? It is a closed user group. The point is that this is a closed user group, right? So which simply means it is an exclusive invite only club for the banks. So when you send a massive amount of money using RTGS or NEFT, the bank uses this highly secure private tunnel to talk to each other safely. So what is the correct answer to this question? The correct answer to this question is option number B. Closed user group communication network operated by IDRBT serve as a backbone, right? Now let's look at the other option they have provided. Option A talks about the UPI and NPCI, and RuPay, which run on a public facing network built by NPCI for everyday retail user, not the secret bank tunnel. If you look at the option C, it is wrong because Infinite is a massive network connecting all the banks, not just internal accounting software for RBI. It is used for connecting all the banks. C is wrong. What about D? D is also wrong because Infinite is strictly for. It says that Infinite is for no cross border, no. It is actually for domestic use within India, not an international alternative to SWIFT. So option number B is the correct answer. So friends, to lock this into your brain, just look at the name Infinite, right? When you see Infinite, right, it literally stands for India Financial Network. When you see the word Infinite, picture an exclusive highly secure network where only bank have the Wi-Fi password. It is a closed club for a heavy lifter. It is a closed club for heavy lifter like RTGS or NEFT, right? If the answer say closed user group, whenever you see this word closed user group, right, and secure backbone, you have found the VIP tunnel. And that VIP tunnel is nothing but now friends, before moving to the next question, let me introduce you to our comprehensive course of CTP. If you are looking for one stop solution for the entire CTP examination, which includes videos, PDF, mock test in English, right, you can check out our course. In this particular course you get mock test, which is which is unit wise, module wise available. Along with that you get videos explanation of each and every concept, and each module have a separate videos, unit wise videos available. Each videos will hardly take 1 hour to clarify the concept, along with separate numerical practices videos, because numerical account for almost 30 to 40% of your examination. In addition to that, we provide you PDF you can take download also, right? Module wise PDFs are available. Inside each module you will get unit wise PDF, you will get separate theory PDF, separate MCQs PDF, right? So this will entirely help you in your upcoming examination. And not only that, we provide you capsule content also for the final revision. So the entire set you can get. Just WhatsApp me on the number shown on the screen, or you can check out the link in the description section to get more detail regarding the course. Friends, now let's shift our focus to the next question that we have. This is regarding the option pricing model. Let's talk about the option pricing model. The question is, in the context of the standard Black-Scholes-Maton option pricing model, which of the following statement most accurately describe the principle of risk neutral valuation? Option A says that it assumes that all the market participants are inherently indifferent to risk. B says that it implies that the expected return of the underlying asset is mathematically irrelevant to the option current pricing. C says that it eliminates the need to estimate the implied volatility of the underlying asset. D says that it requires that the option can only be exercised at expiration, neutralizing early assignment risk. These are the 4 options that they have provided. So we have to answer the correct question. So to answer this question, let me introduce you to a very important concept. Imagine that you are at casino. Where you are at the casino. Fine. Usually, if you play a high risk game, suppose if you play a high risk game, so you will demand a high potential reward, isn't it? You will demand a high potential reward. But what if if you found a mathematical loophole, suppose you found a mathematical loophole, right? What if you could place a bet on both red and black at the same time? You could place bet on red and black at the same time, right? Balancing them perfectly, so you are guaranteed not to lose a single penny, not to lose a single penny, because your risk is perfectly balanced. This right, your risk is perfectly balanced at the rate zero, right? You are not gambling anyone anymore. You are not gambling, right? Your return would not just be a baseline guaranteed amount like earning interest in a regular saving account, right? Your return would be just be a baseline. So see what I'm telling you. What if you could place bet on both red and black at the same time, balancing them perfectly, so you are guaranteed not to lose a single penny, because your risk is perfectly balanced. In such case, your risk is perfectly balanced, right, at zero. So you are not gambling anymore. Your return would be just a baseline, right? That would be your return. Guaranteed amount like earning interest in a regular saving account. In the financial world, the blacks call Merton model figure out how to do this perfectly balanced bet. Yeah, this call, blacks calls Merton, right? This model, they figure out how to do this perfectly balanced, right, bet. This called perfectly balanced bet with stock and option, right? With what kind of instrument? Stock and options, because they can magically hedge away all the risk. It absolutely does not matter how wildly profitable the underlying stock might be in the future. The stock expected return become totally useless for our pricing math. Yes, the stock expected return, it becomes useless. Expected return has no use, right? So instead, what we do, because we have engineered a risk-free scenario, we just use the safe, boring, risk-free interest rate to figure out the option pricing today. What we use? Risk-free interest rate. Yeah, we use the boring risk-free interest rate to figure out the option price today. Our objective is to figure out the option price today, right? We price it as if the world is totally neutral to the risk. Our main objective is to find the option pricing. We price it as if the world is totally neutral to the risk. So if you look at the option that they have provided, the correct answer to this question is option number B. It implied that expected return of underlying asset is mathematically irrelevant to the option current price, allowing cash flow to be discounted at the risk-free rate. If you look at the option number A, it is a trap. It says real people don't care about the risk. Market participants are inherently different to the risk. But in the real world, investors definitely care about the risk. Risk neutral is just a math trick, not a human psychology. If you look at the option number C, it says that it is horribly wrong, because volatility is actually the most critical ingredient in the black skull recipe. It says that it eliminates the volatility. No, 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 that's wrong. Option number D, if you look at it, describe a European option. European option that can be exercised at the very end, which is the rule of the standard model, but is not what the phrase risk neutral, risk neutral valuation means. That's wrong. So to remember this for the examination, think of the car sitting in neutral. Yeah. So if you want to remember this black skull Morton Matter model, you can think of the car which is sitting in a neutral mode. When your car is shifted to neutral, you can stomp on the gas pedal all you want, right? You can stomp on the gas pedal, or right, all you want, but the car will not move forward. The engine, that is engine revving, or the expected return, is totally disconnected and mathematically irrelevant to your speed. So remember, whenever I say this word risk neutral, right, risk neutral, this means expected return is disconnected. It simply means what? Risk neutral means what? Expected return has got disconnected and mathematically irrelevant. Just coast on the risk-free rate. That's it. I hope this is crystal clear now. If you really think that this is adding value to your preparation, do hit the like button. Now let's shift our focus to the next question, calculation of modified duration. This is the numerical part, right? So what they have given, a corporate treasury desk hold a CC. They have mentioned the semi-annual paying government bond. The bond currently has a Macaulay duration of 7.5 year, trading at YTM of 6% per annum. You have been asked to compute the modified duration and estimated percentage price change if the market yield suddenly undergo a parallel upward shift of 50 basis point. They have given you the four options. You have to select the correct one. Friends, how do we go about computing the modified duration? Let's break this down into bite-sized pieces without the financial jargon. So first of all, you can think of the modified Macleod duration as a timer, right? So whenever I say Macleod duration, you can think of like a timer. Okay, it simply measure in years how long it will take for a bond to pay you back your true cost. So in this case, the time they have given is how much? I think 7.50 years. Fine. Yeah. So Macleod duration, this is the time they have given, 7.5 years. But investors don't care about time. They care about, price swing. What investor care about is the price swing, right? To measure how sensitive the bond price is to the changing interest rate, you know it very well that bond price is inversely proportional to the interest rate, right? So how much sensitivity has bond price with respect to the interest rate, right? So what we do, we have to tweak that timer slightly. We have to change that timer slightly, and we call this tweaked version, right? We call this tweak version. Tweak means, changing. We call this tweak version as a modified duration. Fine. Next, you need to know the golden rule of the bond, and the golden rule of the bond is called, seesaw effect. I told you already that bond price and interest rate sit on the opposite end of the seesaw. If the interest rate goes up, the price of the bond goes down. In our story, you can see in this particular case what they have given, that interest rate just go up by 50 basis point, right? Upward shift of 50 basis point. That interest rate has gone by 50 basis point. That is just banking slang for a half percent. You can call it 0.50%, because the rate went up. So we know for a fact that our bond price is going down, right? So now, how to go about finding the modified duration? See, first of all, modified duration. You take the Macleod duration, right? You know it very well that modified duration is equal to Macleod duration divided by 1 plus YTM to the power n divided by n, right? So you can see they have already given it is a semi-annual bond. They have mentioned this word, semi-annual. What does it mean? It means twice a year. So what is the annual interest rate they have given? Annual interest rate they have given is 6%. They have given 6%. So 6% divided by 2, which is equal to 3%. Right? Either you write it 3% or you can say 0.03. Okay. So what is the math? Macleod duration they have given 7.5 upon 1 plus 0.03. That will be 7.5 upon 1.03. That will give us 7.28 years, right? 7.28 years. If you look at the option, so this eliminate option number A and option number C, right? B and D are maybe correct. One of them may be correct. Now let's talk about the finding the price change. That's the second part of the question. How do you go about finding the price change? Very simple, right? So we are talking about the price change. It's very simple. What we need to do, we need to multiply the modified duration with the change in interest rate, right? So how much is the modified duration? 7.28. How much is the change in interest rate? That is 0.50 percentage. That means that will give us 3.64 percentage. Okay. So this is your price change. But remember the seesaw. Do you remember the seesaw? Yeah. I told you, na. In one side of seesaw there is your price, other side there is interest rate. So interest rate is what? Interest rate is increasing, so price will go down. Okay. So interest rate went up, the price must goes down, so the change is negative. So this is minus 3.64 percentage. So this eliminate the option number, I think B. Yeah, it say plus 3.64. This is wrong. Correct answer is option number D. Okay. So to breeze through this in the exam day, just remember the phrase, modify the MAC by half year and then seesaw the price. Just remember this. Modify the MAC by half year and then seesaw the price. So which means, whenever you semi-annual physically slice the interest rate in half before you divide by the Macleod duration, and rate went up, so a huge down arrow next to your price, you can eliminate any positive price, right? I hope the concept is crystal clear. Now question number 7, we have very good question related to the uniform price auction. So the question is, in the context of, primary market issuance of government security by Reserve Bank of India, which of the following best characterize a uniform price auction? Option A, bids are arranged in descending order of price, and each successful bidder pays the exact price they bid. Option B, all successful bidders are allotted the securities at the lowest accepted price, effectively mitigating the winner curse. Option C, the central bank allocates securities at the weighted average price. Option D, only non-competitive bids are accepted and the price is determined by the secondary market yield. These are the four options they have provided, and let me explain using an example. Friends, imagine you and your friend are bidding on a limited batch of 10 VIP concert ticket. Okay, so there's a limited batch of 10 VIP concert ticket. So you are desperate to go. So what you do, you bid 5,000 rupees. Fine. Your friend bid 4,000 rupees and someone else bid 3,000 rupees. Now the seller accept the top 10 bids. Seller accept the top 10 bids and the lowest winning bid cutoff is 30,000. So if this were a traditional auction, you would have to pay your full 5,000. You would immediately feel a pit in your stomach, realizing that you overpaid by 2,000, isn't it? You overpaid by 2,000 because the lowest bid is 3,000. Right. In the finance, that terrible feeling of overpaying, right? In the finance, that terrible feeling of overpaying is called the winner curse. It's called the winner curse. But a uniform price auction is different. We are here talking about the uniform price auction. It is different. The seller look at that 3,000 cutoff price and say, congratulations to everyone who bid 3,000 or higher. You will all get ticket and you all only have to pay uniform price auction. The seller look at that 3,000 cutoff price and say, congratulations to everyone who bid 3,000 or higher. Right, you will all get ticket and you all have to pay 3,000 only. Suddenly you feel great. You bid high to guarantee your spot, but you only had to pay the lowest accepted price because the seller is looking at that. He has decided the 3,000 cutoff price, and you will all get the ticket and you only have to pay 3,000. So you are getting your 2,000 back. So you feel great, right? So the RBI uses this method for government bond. So bank are not afraid to bid aggressively. That is the point. Okay. So the bank the same method RBI use, right, for the government bond. RBI use the same method for the government bond so that the bank are not afraid to bid aggressively because they know if they bid more aggressive, right, they are getting the minimum they have to pay only. That is the cutoff, and above that whatever they have paid they will return. Okay, that is the point. So if you look at the option that they have, that's called uniform price bid option. Now, if you look at the option they have given, yes, B is the correct answer. All successful bidder allotted the security at the lowest accepted price, the cutoff, mitigating the winner curse. Exactly. That is what the uniform price auction is all about. Okay. I hope this is crystal clear. So the correct answer is option B. Let's quickly eliminate the other. Option number A, describe a multiple price auction. Yeah, this is called, multiple price auction. Sometimes question may be asked, what is a multiple price auction? So in that case, what happened? Where you actually pay what you bid. Hello, winner curse. Yeah, that is the case of winner curse. That's called multiple price option. Because how much you have bid, you have to pay that. That's called multiple price auction. And if you look at the option C, it is also incorrect. Why? Because the RBI does not average the price out. It says that averaging the price. No. They strictly use the cutoff price. RBI does not average the price. What they use? They use the cutoff price. And if you look at the option D, it is completely wrong because competitive bid, are the entire point of holding an auction in the first place. Right? They say that only non-competitive bidding are accepted. No. Competitive bidding is are accepted. So when you see the word uniform, see, to remember this, let me tell you a trick. So whenever you see this word uniform, just remember, think of a school uniform, right? So uniform, you can think of a school uniform, right? What is the point of a school uniform? It makes sure that every single student looks the same, looks the exact same, right? So that nobody feel foolish or left out. So remember, in the uniform price auction, right, everyone pays the same price. Because everyone pays the same cutoff price, nobody feel foolish, which magically cures the winner curse. Now have a look at the next question we have. So this is question is regarding the annualized yield of treasury bill. Very good question it is. So a bank treasury department purchases a newly issued 91-day treasury bill with a face value of 1 lakh, cutoff price 98350, standard 365 day per year. What is the true yield or annualized yield of this T bill? Four options they have given. So let me give you a simple example to make it this concept crystal clear. Imagine that you buy a guaranteed winning lottery ticket. What you did, you buy a guaranteed winning lottery ticket, okay, from a friend. The ticket will pay you exact how much? 1 lakh. The ticket will pay you exact 1 lakh in 91 days. Your friend say, give me 98350 today. Give me 98350 today. and you can keep the 1 lakh when it's pay out. So your actual profit is the difference. How much is your actual profit? The profit is your difference, which is I think 1650 in this case. But here is the catch. When you brag to your family about how much money you made, you want to compare it to a normal bank saving account. Bank actually always advertise their interest rate for a full year. Right? What bank do? They advertise their interest rate for the annualized basis, or we call it, full year basis. Right? You've only held this ticket for 91 days, isn't it? You've only held this ticket for 91 days. To find your true yield, you have to do two things first. Actually, what we are interested in finding the true yield. To find the true yield, you have to do two things. First of all, you have to calculate the profit you made based on the money that actually left your pocket. So the money that left your pocket is 98350, and the profit you made, first thing you have to calculate. And second, scale that 91-day profit up to see what it would equal if you kept repeating this exact same deal for a full 365 days. Right? So, because you want to brag about the profit you made to your family member, so you want to compare, you want to analyze it. First of all, you calculate the profit, right? And then scale that 91-day profit up to see what it would be equal if you keep the repeating the same for full 365 days. So first of all, you find the profit. The profit is very simple. 1 lakh minus 98350. That is how much? I think 1650. This is the profit. Now you find the holding return. So divide this profit. So basically you have to find the holding return. So you divide your profit by the money you actually invested. So 1650 upon 98350, right? That will give you 0.01677, or we can say 1.67%. That's called holding return. Now we analyze it. So in how many 91-day period are there in 365 days? So 365 divided by 91, right? Multiply your return by this into 360, yeah, into 0.01677 into 100. So that will give you 6.73%. So we can confidently dismiss the other option. Like you can see, other option they have given 6.62, 6.64, right? Because they are the trap, right? So to avoid the biggest trap in the calculation, remember the phrase, the true yield uses true out of pocket. True out of pocket, right? When you calculate your percentage, never divide by 1 lakh you have not received yet. Always divide by the true out of pocket cash that you spent today. Most of the time mistake what happen, we divide by 1 lakh. No, no, no. 1 lakh you have not received yet. What have gone out of your pocket, that is 98350. You have to divide by that. That give you the holding, right? Holding return. And that return, analyze it, that will give you 6.73%. So I hope scale it up to 365 days, and you will get the math right every day, every time, whenever you calculate it. I hope this is crystal clear. Now let's look at the next question. This is the comprehensive treasury and portfolio concept. Very good question. This type of question are frequently being asked in the examination. So a treasury manager at a commercial bank is reviewing regulatory limit for money market operation and analyzing the recent investment performance. So which of the following statement correctly reflect the established RBI guideline and standard portfolio definition? Option number A. For when issued security, the aggregate net short position are capped at 95% of the RBI notified amount monitored on NDS OM platform. B says that when the bank issue interbank participation certificate strictly under a non-risk sharing basis, the maximum permissible period of issuance is 91 days. Option 3 say, during a portfolio analysis study, active return is calculated as active return is equal to portfolio actual return minus benchmark actual return. So there are four options they have provided, right? So now let's break this big statement down into simple everyday concept. So friends, imagine a popular sneaker brand announced a new shoe. So let's suppose there is a sneaker brand, and what they have done, they have announced a new shoe. Okay, but it has not actually been manufactured yet. It has not been manufactured yet, right? So sneakerhead start selling pre-order to each other. What they start selling? Pre-order to each other. So to prevent the chaos, the brand say you cannot pre-sale 100% of the factory capacity. What does the brand say? Brand say that You cannot pre-sell. You cannot pre-sell 100% of the capacity, right? Just in case something goes wrong, we are capping you at 95%. In the bond market, RBI does the same thing with the government bond that are announced but not yet issued. There are some government bond that are announced but not yet issued. So RBI does the same thing. They cap the pre-selling at 95% to keep the market stable. They cap the pre-selling at 95%. Okay, that is what statement number 1 is all about. As you can see, when issued, right? For when issued security, the aggregate net short position is capped at 95%. Exactly. Now let's look at statement number 2. So IBPC on a non-risk sharing basis. Yeah, statement number 2 is talking about the right IBPC on a non-risk sharing basis. Let's talk about it. Imagine you lend some money to a friend. This is you, and you lend your money to your friend, right? And another friend steps in to guarantee you get paid back no matter what. So this is the third friend. He is giving you a guarantee. He is giving you a guarantee. No matter what, I will pay you. So because it is totally risk free for you. The RBI has a strict rule for bank doing this, right? What is the RBI rule? That this super safe non-risk sharing, this super safe non-risk sharing loan between bank can only be short term. This super safe non-risk sharing, lending between bank can be short term. The maximum allowed time is exactly quarter of a year. That is 91 days. Quarter of a year. That is what statement number 2 is all about. It says that when the bank issues interbank participation certificate or IBPCs strictly under non-sharing basis, maximum period. Yes, exactly. Now let's look at statement 3. This is all about the active return. Let's talk about it. So think about your child bringing home a math test. So let me give you an example for statement number 3. Suppose this is your child, and what he is bringing? He is bringing math test, right? The class average was 75%. What was the average class? The class average was 70%. And your child actively studied and scored how much? 85%. This is your child scored. Your child scored 85%, right? So the active return, if you look at the active return, so that extra 15% is the extra 15% they earned above the class average. In finance, you just take your portfolio actual return and subtract the market benchmark. You take the portfolio actual return and subtract the market benchmark. So the correct answer is option D. All are correct, right? So to remember the concept is for the examination, just remember this trick. What trick? 95, 91, AB, which means 95 means RBI stops you just short of 100% on a pre-order. When issued is capped at 95%. 91 means a risk-free bank loan. A risk-free bank loan lasts exactly quarter of a year. And AB means active return equal actual minus benchmark. AB means actual return equal actual minus benchmark. Just jot it down, 95, 91 and AB on your scratch paper, and you'll never miss this question. And friends, we have more question available, description of which I will provide in our course. Right. If you want to get access to the remaining question, you can enroll in our course. You can WhatsApp me on this particular number to get more detail related to the course. That is all for today. Have a nice day.